Thanks very much for joining today's call for single-family MBS and CAS investors. My name is Sonia Bobian. I'm Fannie Mae's Vice President of Investor Relations and Marketing. So as the situation around COVID-19 continues to evolve, we absolutely recognize these are unprecedented times. And first and foremost, before we get started with today's call, our thoughts are with everybody here. At Fannie, we've put policies in place to help keep our people healthy and to keep our business open so we can deliver for our customers, the housing market, and the broader economy. I'll introduce the colleagues on the line with me and go through a couple of quick administrative items before we get started. Today, I'm joined by several of my colleagues, including Cindy Danko, the Vice President of Single Family Credit Risk Policy, Caroline Patain, a Vice President of Single Family Credit Risk Counterparty, Jake Williamson, who is our Vice President of Single Family Credit Risk Collateral Management, Art Johnson, our Director of Securitization Policy, and Kathleen Pagliaro, our Director of Credit Risk Transfer. Before we get started, I do want to remind participants that this presentation may include forward-looking statements, including those related to our future business, future activity by lenders and borrowers, and the impact of recent policy changes. Actual results may differ materially as a result of many factors, including the duration and magnitude of COVID-19 related shutdowns and social distancing, as well as those referred to in forward-looking statements in Fannie Mae's Form 10-Q for the quarter ended March 31st, 2020, and Form 10-K for the year ended December 31st, 2019. This call may be recorded by Fannie Mae for business purposes. By participating in a recorded call, you consent to being recorded, and if you do not wish to be recorded, do not participate in the call. The current situation is highly fluid, and any policies or practices discussed on the call are subject to change as we in FHFA react to the impact of the COVID-19 pandemic on borrowers and the broader mortgage market. So with all of that, we'll go ahead and get started. I'm going to first chat with Cindy. Fannie Mae has put out a number of announcements for sellers and servicers in response to COVID-19. Let's begin with servicing. Could you provide an overview of the COVID-19 forbearance and post-forbearance options?
Sure, Sonia, happy to. As a reminder, forbearance is a plan that allows for reduced or suspended mortgage payments for a designated period of time. In terms of a forbearance for a borrower who's impacted by COVID-19, servicers must comply with the terms of the CARES Act, which require that a forbearance plan be provided to any borrower who requests a forbearance with an attestation to a financial hardship that was caused by the COVID-19 emergency. No additional documentation other than that borrower attestation to a financial hardship caused by COVID-19 is required. The borrower must be provided an initial forbearance plan for a period of up to 6 months, and that forbearance period can be extended for an additional 6 months at the request of the borrower. Following forbearance, the borrower is not required to repay missed payments all at once, but they have the option to do so through reinstatement. If the borrower cannot afford reinstatement, the borrower can set up a repayment plan to catch up gradually. And if the borrower can't afford that repayment plan, the servicer must consider a payment deferral option. And with Lender Letter 2020-07, we introduced COVID-19 payment deferral, which is a new home retention workout option, jointly developed with Freddie Mac and at the direction of FHFA. The new COVID-19 payment deferral option is specifically designed to help borrowers who are impacted by a hardship related to COVID-19, and it helps them return their mortgage to a current status after up to 12 months of missed payments. Beginning July 1st of 2020, the COVID-19 payment deferral will be available for borrowers whose hardships related to COVID-19 have been resolved and who are able to continue making their full monthly contractual payment, but can't afford the reinstatement or repayment plan as previously discussed. If the servicer is unable to establish QPRC, as we described in that Lender Letter 2020-07, with a borrower on a COVID-19 related forbearance plan and the borrower is ineligible for COVID-19 payment deferral, then the servicer must evaluate the borrower for the Fannie Mae Flex modification in accordance with the reduced eligibility criteria for a borrower impacted by COVID-19. Lender lender letter 2020-07 details that for COVID-19 impacted borrowers on the effective date July 1st, the COVID-19 hierarchy includes payment deferral and flex mod. As of that date, extend and cap and extend mods are no longer part of that COVID-19 hierarchy. Once the servicer implements COVID-19 payment deferral, it must evaluate impacted borrowers in accordance with those eligibility requirements and the evaluation hierarchy that are described in the lender letter.
Thanks, Cindy, for walking through the details of that letter. And since we had the recent update just yesterday afternoon as it relates to the hierarchy change, could you talk a little bit about how the flex mod works?
Sure. So the flex modification was released in 2016, and it's also aligned with Freddie Mac, again, at the direction of FHFA. It's designed for a borrower who needs a reduced payment because they can't maintain that existing monthly mortgage payment they had. To determine the borrower's new modification or modified mortgage loan terms under FlexMod, the missed P&I payments and escrow advances, which include the taxes and insurance advances, are first capitalized into the mortgage balance. Then there's a waterfall of modification steps, interest rate assessment, term extension, principal forbearance, that's applied to target a 20-cent reduction to that monthly mortgage payment. The servicing guide and lender letter 2020-07 have more detail about that.
That's great, thank you. I'm gonna switch over to Caroline for just a couple moments. You know, we've certainly gotten questions around monitoring our servicer financial health, so maybe we can talk a little bit about that. How are we looking at servicer financial health if there are incremental liquidity needs for providing servicer advances given potential increase in delinquencies?
Sure, I'm happy to talk about that. Thank you, Sonia. So each quarter, we perform an assessment of the minimum financial requirements to ensure our active sellers and servicers meet the minimum net worth, minimum capital requirements, and specifically for non-banks, that they meet the minimum liquidity requirements. Sellers and servicers are expected to manage their own warehouse lines to support loan originations and to maintain liquidity and access to bank credit facilities to make advances. For securities that are backed by scheduled remittance loans, which are typically lender-formed MBS, the servicer covers the full month's interest in the event of a payoff. For securities backed by actual remittance loans, which are typically MBS formed by Fannie Mae will cover the remaining interest. And later, Art's going to explain more about the advancing requirements and the servicer reimbursement policies.
That's great, thank you. Have you guys started stepping up assessments that you do with servicers given COVID-19?
So the standard assessments have not increased due to the standard reporting requirements. However, through the STAR program, we are evaluating operational implementation of all the servicing guide requirements, including the recent updates found in the lender letters on servicers included in the STAR program. The STAR scorecard also remains our means of monitoring the servicer's portfolio performance on key credit metrics, and all STAR program information can be found on fanniemae.com. Additionally, there is a targeted approach to analyzing the counterparty data with proactive outreach being conducted by the counterparty risk team and the customer management solutions group, who have direct interaction with our servicers. The Fannie Mae counterparty risk management teams are regularly completing an analysis to identify potentially at-risk counterparties and will engage in discussions around their liquidity position, liquidity strategy, among other topics to help ensure the appropriate oversight and actions are being taken timely.
Thank you. And certainly I know servicing transfers are something that we have sort of in our toolkit generally. Could you speak to an overview of how servicing transfers work?
Yes. So servicing transfers are a fairly common activity, and Fannie Mae has practices in place to evaluate servicer-requested transfers that requires both parties to be Fannie Mae-approved servicers. There will be times when Fannie Mae will initiate action to move loans to different servicers for various reasons, including market conditions, economic factors, the servicer's performance, or any combination of the above. Fannie Mae will work to identify the appropriate new servicer, and for the portfolio of loans, in a few scenarios that would require Fannie Mae approved loan transfers would include if Fannie Mae were to purchase servicing and place the loans with a different servicer as a targeted portfolio movement to a Fannie Mae subservicer, or it may be that Fannie Mae has approved a sale to a different servicer, so it's just servicer to servicer movement. In the event that a servicer is initiating the action where they want to exit the business, we would consider that a voluntary termination and assist with the transfer of the loans. Or if there were a reason where Fannie Mae were to exercise contractual rights, that would be considered an involuntary termination. And in each case, again, we're working with each of the Fannie Mae approved servicers to ensure that the receiving servicer has the appropriate capabilities and capacity to take on that portfolio.
Great, that's helpful. Thank you. Cindy, I'm going to turn back to you for another couple of questions. We've received some questions from the market community around, concerns that borrowers who don't need support will receive temporary payment forbearance as a result of the changes to COVID. Can you just speak to what sort of documentation is required?
Sure, thanks, Sonia. So as I have mentioned just a few minutes ago, based on the CARES Act, a forbearance plan must be provided to a borrower who requests forbearance with an attestation of financial hardship due to COVID-19, with no additional documentation required. Fannie Mae does require that servicers follow all applicable laws. When offering a forbearance plan, the servicer does have to document the individual mortgage loan file, the borrower's request for forbearance, and the attestation as to financial hardship caused by COVID-19. And the loan file documentation must also include the terms of the initial forbearance and any extended forbearance plan, including the full duration of that forbearance plan.
Great, thanks for that. Could we spend a few minutes to review some of the temporary policies that were put in place on the origination front and steps we're taking from an underwriting standpoint?
Sure. So we've made a number of updates as we think about selling policy and the origination side. Lender Letter 2020-03 introduced some of those temporary policies, including flexibilities for the lender's process in obtaining verbal verifications of employment. We updated our age of documentation requirements for most income and asset documentation to be no more than 60 days old as of closing versus the standard policy, which was 120 days previously. We also added requirements for lenders to confirm for self-employed borrowers that the self-employed business is open and operating within 10 days prior to closing. We also introduced some temporary policies in Lender Letter 2020-06 for acquiring loans that entered a forbearance plan after the loan closed and prior to delivery to Fannie Mae. And all of those, all the lender letters that I've mentioned on this call are available on our web pages.
Great. And how much does Fannie Mae expect that these policy changes will alleviate bottlenecks due to COVID-19?
So that's a good question, Sonia. These are really unprecedented times, and we continue to actively attempt to address potential disruptions in the manufacturing process. We've provided alternatives to lenders, as I mentioned, for validating employment, expanding the use of powers of attorney. We added more states to be eligible for using remote notarization on closing documents, just to name a few of the items we've addressed. We recognize that there's many challenges facing our lenders and servicers, some of which we may not be able to solve, but we are attempting to anticipate and address those disruptions as they come in, and we're in constant contact with lenders and servicers for their feedback. So we have a really good sense of what the challenges are and what we can do to help them.
That's great. And finally, is Fannie Mae changing the rep and warrant relief principles given the current environment?
So the lender's representations and warranties don't change. Lenders are required to follow standard policies related to income stability and calculation. And while we're allowing certain documentation alternatives, such as the verification of employment detailed in Lender Letter 2020-03, lenders are not required to use these alternatives if they're not comfortable with them.
That's great. Thanks very much, Cindy. I'd like to turn it over to Jake Williamson to talk a little bit about some of the collateral policies and some of the temporary changes we've made there. Jake, could you touch on the lender letters regarding temporary changes to appraisals in response to COVID?
Yeah, thanks. Good afternoon, everybody. And I just want to reiterate what Sonia said at the top of the call. I hope everyone is staying safe and healthy during this uncertain time of COVID-19. As of last week, Tuesday, May the 5th, we've produced 4 different lender letters that relate to appraisals and our collateral-related processes. The first lender letter was released on March the 23rd, and its main purpose was to announce additional and permissible appraisal types based on loan purpose type, occupancy type, and LTV. And at a high level, both desktop appraisals and exterior-only appraisals, which we commonly refer to as drive-by appraisals, were authorized on purchase transactions for primary residence properties across all LTVs, and then for second homes and investment properties, but we capped the LTV at 85%. For rate and term refinances, which you will hear us commonly refer to these as LCORs, exterior-only appraisals were authorized where the GSE already owns the loan or already owns the risk. So for us, this would be a Fannie to Fannie refinance transaction, and in Freddie's case, it would be a Freddie to Freddie refinance transaction. In this same lender letter, we encouraged lenders to take advantage of appraisal waivers as a way to achieve additional field work relief, given the ongoing challenges with COVID-19. On March the 31st, we updated this lender letter to allow these appraisal product types to be utilized in the new construction process, but we layered on some additional controls for the lender and the builder to follow. For example, we highlighted some additional documentation and photo requirements needed for the appraiser to complete the desktop or exterior-only appraisal. These are things like plans, specs, the survey, the plot, and all the various exterior and interior photos that are required for the appraiser to be able to complete that appraisal. We also introduced a builder certification document that must be executed attesting that that information is accurate, and this certification is stored in the loan file by the lender. In this same update, we provided some additional flexibilities for the home style renovation product, specifically in the draw process where COVID-19 might be preventing an inspector from reviewing and signing off on the repairs. Similar to the builder certification in new construction, we wanted to introduce what's called a completion of construction certification, basically outlining the photos and the documentation requirements to signify repairs have completed so that the next draw in the process can proceed. Next, we updated the lender letter on April the 14th, and that was really done for 2 primary purposes. One was to provide some flexibilities on condo project review waivers for existing Fannie Mae owned loans that we're looking to refinance via rate or term change. Again, we call those LCORs. And then the second big body of work associated with that lender letter was a lot of policy clarifications. For example, highlighting how and when to utilize virtual inspections, how to fill out the MAP reference ID in the appraisal form so that the correct appraisal type can be noted. And then just being real crisp that new construction has to follow the same grid as all the other property types has to follow with primary or occupancy and LTVs. And then finally, we updated the lender letter on May the 5th, noting that these temporary flexibilities will remain in place for loans with application dates on or before June 30th of this year.
Thanks, Jake. That was really helpful. And for those on the call, we're updating its lender letter 2020-04. Is that correct, Jake? When we continue to update our appraisal policies?
That's correct, Sonia.
Perfect. Thanks. So let me turn it over to Art Johnson to talk a little bit about some of the sort of reporting and disclosure. Art, would you be able to walk through what we're doing as it relates to reporting for MBS and CRT investors?
Absolutely, and thanks, Sonia. So for MBS and CRT disclosures, they're very similar. So let's start with payment forbearance. So when a loan is in a temporary payment forbearance plan, and if that borrower is not making payments, it will be disclosed as delinquent. Now, some borrowers in a forbearance plan may make partial payments, and if collectively these partial payments make up a full payment, then it would reduce the number of months delinquent being disclosed. Now, there are also maybe instances where a borrower makes a contractual monthly payments, even though they have requested a payment forbearance. And in these cases, we would disclose the loan as being current. Now, one thing I do want to note is that if a borrower has requested to be in a forbearance plan, we will disclose that loan as being in forbearance, even if that borrower is current. Now, going to reinstatement. So after a payment forbearance plan, if the loan is brought current through a reinstatement, it will be disclosed as current. For a repayment plan, if the loan is in a repayment plan following a forbearance plan, it will be disclosed as delinquent until the repayment plan is complete. As the borrower gradually repays the missed payments over the term of the repayment plan, the loan will be reported as progressively less delinquent until the plan is complete and the loan is reported as current. For the new payment deferral plan, if the loan enters into a payment deferral plan, it will be disclosed as current upon the execution of that payment deferral plan. And finally, for modifications, if the loan is being evaluated for a modification, such as the flex modification, it will be reported as delinquent during the modification trial period plan. For CRT disclosures, the loan will be reported as current once it is in a permanent modification. But for MBS, that loan would generally be removed from the trust prior to the completion of the permanent modification. With our CRT deals, we currently disclose forbearance and delinquency. As for MBS, Fannie Mae announced on May 4th, in conjunction with Freddie, that we are making enhancements to our MBS disclosures related to delinquency and borrower assistance plans, which would include disclosing forbearance, repayment, and trial mod plans. Starting just last week and corresponding to our Lender Letter 2020-06 announcement regarding the purchasing or securitizing loans that are in forbearance, we started publishing daily a new disclosure file that provides pool-level statistics on loans that may be in forbearance and possibly one month delinquent for all newly issued securities. And beginning with the June monthly securities disclosures that will be published on the 4th business day in June, for all outstanding securities, Fannie Mae will start disclosing pool-level statistics on loans that are in certain borrower assistance plans. Again, no forbearance, repayment plan, or trial mods. And in addition, we will be expanding our disclosures of days delinquent and involuntary loan removals at the pool level for all securities. Previously, we only disclosed these attributes for securities issued on or after November 2018.
All right, thanks very much. I know that covers a lot of the questions that we're getting as it relates to reporting. Could you talk a little bit about the implications for MBS cash flows of these various policies around COVID?
Yeah, absolutely. So I just want to start off as a reminder that, pursuant to Fannie Mae's guarantee of our certificates, MBS investors receive scheduled P&I payments for all loans in the MBS pool, regardless of the status of the borrower. And in addition, as stated in our MBS trust agreements, Fannie Mae has the option, but it is not required to remove loans when the borrower becomes 4 or more consecutive months delinquent. Currently, though, our general practice is to remove loans from the MBS when the borrower is delinquent with respect to 4 consecutive full payments. So, okay, for a loan in a payment forbearance that is in a Fannie Mae MBS, Fannie Mae's current practice is to keep the loan in the MBS even if the loan is reported as being 4 or more months delinquent. And while that loan is in forbearance and in a Fannie Mae MBS, investors will continue to receive scheduled P&I, again, under Fannie Mae's guarantee. Now, at the expiration of the forbearance plan, if the loan is brought current through a reinstatement, or it immediately enters into a repayment plan or a payment deferral plan, then that loan will remain in the MBS and investors will continue to receive their scheduled P&I. However, if a loan does not become current at the end of the forbearance plan, the servicer may extend the forbearance period, which would generally allow the loan to remain in the MBS and the investors continue to receive scheduled P&I, or the borrower would be evaluated for another loss mitigation option. Currently, any loss mitigation option that results in a modification will generally require the loan to be removed from the MBS. However, during any modification trial period, that loan will remain in the MBS until the trial period ends.
Thank you. I know that Caroline alluded to this earlier, but we do receive a lot of questions about when servicers are reimbursed for their advances. Could you address that?
Sure. So currently, for loans that are sold to Fannie Mae with our scheduled admittance type, Fannie Mae servicers are required to advance principal and interest in the event a borrower is delinquent, including loans and forbearance, until the loan is either brought current by the borrower or the loan is purchased out of the MBS by Fannie Mae. So how do they get reimbursed? Well, a few ways. So a servicer can recoup the advance funds by the P&I payments made by a borrower who becomes current, either through a reinstatement or a repayment plan. For the payment deferral option, a servicer is reimbursed by Fannie Mae at the time the loan enters into that payment deferral plan. And then for those loans that are purchased out of the MBS trust by Fannie Mae, such as delinquent loans not in one of the plans I just mentioned, or prior to the completion of a loan modification, servicers are reimbursed by Fannie Mae at the time the loan is removed from the trust. Now, we are changing our current advancement criteria as announced on April 21st, so that servicers will no longer have to advance principal and interest after 4 months of delinquency, including forbearance, if that loan remains in the MBS. After that fourth month, Fannie Mae will advance the scheduled principal and interest payments to the MBS trust, again, as long as the loan remains in the MBS trust. Now, this change will be effective starting with the August 2020 servicer remittances, which is related to the July reporting cycle. So if there are any changes to the reimbursement process that I just mentioned as a result of this new advancement change, we will definitely be announcing that broadly. Now, I've just been discussing the scheduled remittance types, but we also have MBS that are backed by loans with an actual remittance type. However, for this remittance type, it is Fannie Mae and not the servicers that advance P&I to the investors. So the advancement changes effective in August will not impact servicers of actual remittance types.
Great. Thanks, Art, for walking through that and providing that clarification. I'm going to turn to our Connecticut Avenue Securities and our CAS program with Kathleen. So, Kathleen, could you walk through implications for CAS cash flows? And let's begin with forbearance.
Sure. Thanks, Sonia. So interest payments to CAS investors are not dependent upon interest collections on the reference obligations. Because of this, reduced interest collections due to temporary forbearance do not impact these payments. However, principal is not distributed to CAS notes unless it's collected from the borrower. As such, scheduled principal collections may be reduced as a result of temporary payment forbearance, which will affect the amount of scheduled principal distributed to CAS investors. Unlike MBS, there is no guarantee of principal for CRT investors, so scheduled principal is not advanced. Now, as it relates to the delinquency test, which is a test included in the actual loss deals, subordinate bonds are locked out from receiving unscheduled principal if the 6-month average distressed principal balance is more than 40% of the subordinate balance. The distressed principal balance includes loans that are 90 days or more delinquent or are in foreclosure, bankruptcy, or REO status. Because loans in an active forbearance plan continue to roll deeper into delinquency by the number of payments not made, these loans may be included in the distressed principal balance and cause the delinquency trigger to trip, leading to the subordinate bonds being locked out of receiving unscheduled principal. Scheduled principal, however, is still passed through to the bonds. It is not locked out. However, for all of the CAS REMIC transactions, which are those designated with an R prefix, the effect of the delinquency test can be mitigated via the allocation of the Supplemental Subordinate Reduction Amount, or SSRA, In the REMIC deals, the percentage of offered notes and their corresponding reference tranches is capped at generally 5.25% or 5.5% of the current UPB of the reference pool. If this cap or threshold is reached, the CAS notes will receive unscheduled principal, even if the delinquency test is failing. And just to go back to the distressed principal balance, it's also important to note that modified loans that are current or less than 90 days delinquent are not included in this calculation, which is a difference from the STACR program.
Thanks, Kathleen, for that. Could you walk through when reference obligations become credit events for the various CAS deals?
Yeah, so for all CAS securities issued under the fixed severity framework, reference obligations become credit events at 180 days or more delinquent, regardless of any grant of forbearance. For CAS securities issued under the fixed severity framework from CAS 2014 C04 through and including CAS 2015 C03, reference obligations that were in a forbearance period due to a casualty event, such as a natural disaster, fire, or theft, at the time it became a credit event reference obligation, will become reverse credit events if the loan had a payment status reported as current at the conclusion of its forbearance period, or up to 3 months thereafter if necessary to allow for the expiration of any trial mod period. A reference obligation that is in a forbearance period due to COVID-19 will be treated as a casualty event for CAS securities issued in the CAS 2014 C04, 15 C01, 15 C02, and 15 C03 transactions. We have not implemented any changes to any of the other fixed severity deals. If any such changes are made, they would be announced broadly to the market. For CAS securities issued under the actual loss framework from 2015 C04 and onward, including REMIC securities, reference obligations in a forbearance plan are not considered to be a credit event.
Great, and we've gotten a lot of questions specifically with the news yesterday that was sent out regarding COVID-19 payment deferral around how payment deferrals will impact CAS payments. Could you walk through that for us?
Yeah, so in cases where loans enter a payment deferral, those loans are not treated as loan modifications for CAS. Under the payment deferral, the deferral of missed P&I payments does not affect the ongoing contractual monthly payment due from the borrower and will not result in a modification loss amount to investors. Further, interest payments to bondholders will continue to be made and will be based on the total loan balance, which is inclusive of all deferred amounts. Borrowers that enter into a payment deferral agreement will resume making their contractual P&I payments. However, those missed P&I payments will not be received by the trust until the loan's maturity or earlier payoff. Upon entering into the payment deferral agreement, the loan will become current. So for actual loss deals, this means that a loan entering a payment deferral will not be included in the distressed principal balance for purposes of the delinquency test. For fixed severity deals, because the loan becomes current when the borrower enters into the payment deferral agreement, a loan that was less than 6 months delinquent prior to entering the deferral agreement will not become a credit event. And for the later fixed severity deals that contain the casualty event provision, if the loan became a credit event while in forbearance due to COVID-19 and the borrower entered into a payment deferral at the conclusion of his or her forbearance period, that loan would become a reverse credit event reference obligation. If a loan in a payment deferral agreement subsequently defaults, the severity will be calculated to include any deferred principal, interest, taxes, and insurance that is due as part of the payment deferral agreement. This treatment is consistent with loans that default and are disposed of through REO positions in which such costs are part of the loss calculation.
And then finally, how are CAS payments impacted when a borrower enters a modification?
Sure. So in cases of permanent hardship where a loan modification is pursued, the implications for CAS investors vary by modification type as well as across deals. If the borrower's hardship is permanent and he or she is unable to sustain the contractual monthly P&I payment, they will be evaluated for the Fannie Mae Flex Mod as part of the COVID-19 workout options, which uses several levers to reduce the monthly payment and may result in a modification loss amount to investors in actual loss deals. As a reminder, there are no modification losses in fixed severity deals. While interest payments to bondholders are not dependent upon interest collections on the reference obligations, certain modifications may result in a reduction of interest on the bonds. Modification loss amounts are passed through to investors in reverse sequential order, reducing the interest payments first, and then, depending on the level of the modification loss amount, could be applied to principal. When a modification is finalized, the loan returns to current status and the borrower resumes making contractual P&I payments. If the amount of these payments is reduced due to permanent hardship, the amount of scheduled principal collected by the trust and distributed to bondholders may be lower. Modified loans are not included in the distressed principal balance unless the loan has become 90 days or more delinquent after the modification. And finally, a modification is not a credit event.
Kathleen, thanks very much for walking through those details. I know that covers a lot of the questions that we've been getting from the market. Before we close out the call, I did just want to remind folks of a number of resources to keep you informed. We do know that the situation obviously is very fluid. There is a lot of information coming out on a very frequent basis. And our goal is to keep you informed as things come out and make sure that folks understand the impacts to, various programs. So there's a couple ways that you can stay engaged. First, sign up for our email distributions at fanniemae.com/CM sign up, and that's CM as in capital markets. As part of those distributions, we provide the announcements, links to lender letters that we walk through today, and other relevant information as we publish it. As Art mentioned, we have enhanced our daily MBS disclosures and are enhancing our monthly MBS disclosures starting on June 4th to provide additional information on borrower assistance plans and delinquency. At fanniemae.com/data dynamics, you can see cohort level performance information, including for CAS, the percent of loans in forbearance, which is inclusive of COVID forbearance for any given deal. We also continue to build out data dynamics for both CAS and MBS resources, so just keep that in mind. And if you sign up for our distributions, you'll get updates as to when those are enhanced. Finally, we do understand that, the market's going to continue to have questions. Please don't hesitate to reach out to us. We'll do everything that we can to answer those. But thank you very much for your time today, and thanks again for our panelists for joining us. And hopefully everybody found this helpful. Thanks so much.